You have to prepare this slide. Monetary policy is implemented. Monetary policy is implemented using the monetary policy tools. Using the monetary policy tools of the central bank. I repeat, monetary policy is implemented using the monetary policy tools of the central bank. Monetary policy is implemented. Monetary policy is implemented. It means once we have framed that monetary policy, then how it will be implemented? It will be implemented using the tools. So today I will be discussing with those three tools. The first tool is the policy rates. When I say policy rates, I will be telling you repo rate, reverse repo rate, and all different rates are coming here. The second is reserve requirement, and the third is open market operation. So please write down these three very highly testable policy rates, reserve requirements, and open market operations. So we'll be dealing with detail that what I mean by policy rate, what I mean by reserve requirement. No doubt I have told you at the time of money multiplier that what I mean by reserve. And there we have concluded that 25% is the reserve which is prevalent in India. It means a banking company, after getting a deposit of 100 rupees in India, 100 INR, can give a loan of 75 rupees to another person by keeping 25 as reserve. So this reserve is the policy. It is a tool of a monetary policy with the help of which this central bank can implement, can control the money activities, and can control and manage the money supply. So we are coming to that. So before that, I want to just show you Reserve Bank of India. This site, India's central bank, and just see these are the policy rates. Policy rates. These are the reserve ratios. These are the exchange rates. These are the lending deposit rates. These are the market rates. So this policy rate and reserve ratios. These are the two tools which I am today going to tell you that what I mean by policy rates. When I say policy rates, just see, policy repo rate is 6.5%, reverse repo rate is 6.25%, marginal standing facility rate is this much. It means when I say policy repo rate, what is the meaning of policy repo rate? It is a tool in the hands of central bank. Reverse repo rate is also a tool in the hands of central bank. Now before that, I want to tell you what is the meaning of repo rate. When I say repo rate, it means the rate at which central bank of India, that is Reserve Bank of India, will lend the money to commercial banks, to Punjab National Bank, to HDFC, to ICICI, to State Bank of India, to State Bank of Patiala. This is the rate at which central bank of a country, that is Reserve Bank of India, will give loan to these commercial banks. And this rate is 6.50%. So when I say 6.50, it means it is a policy repo rate. It is a policy repo rate. It means if this rate is decreased from 6.50 to 4% or 5%, then think of a scenario, have a thought process that what will happen. And if this policy repo rate is increased from 6.5 to 9%, 10%, then think of a scenario that what will happen. So if the repo rates are increased or if the repo rates are decreased, then what will happen to the liquidity of the commercial banks? That we have to discuss today. So I am on to that if repo rate has been increased, the first point which I want to tell you is policy rates. Policy rates means repo rate and reverse repo rate. I am telling you for repo rate, the rate at which banks will borrow from the central bank. And for India, I will say RBI, and for USA, I will say US Fed. The rate at which banks will borrow from the central bank, that is named as policy rate. If central bank increases the repo rate, if central bank increases the repo rate, then borrowing cost will increase, then borrowing cost will also increase. Very simple. If repo rate has been increased, that the rate at which this central bank will charge from this Punjab National Bank, from any commercial bank, is increased, that is 9%, 10%, it means the banks can lend the money at higher rate, then only this bank, commercial bank, will be at a win-win position. then only this commercial bank will be at a profitable position. Because if they are borrowing at 9% and if they are lending at less than 9%, this bank will having a loss position. So the borrowing is the cost for this commercial bank, and the lending rate to the investors, to the public, that is a income for this commercial bank. And it is but natural that income should be more than the cost. It means the lending rate by this commercial bank should be more than the borrowing rate by this RBI to commercial bank. You getting a point? Now the point is, when this borrowing rate is more, then automatically there will be a liquidity crunch in the hands of public, in the hands of banking company. And because bank will increase their own lending rates, and when lending rate will increase, in that case people will borrow less because interest costs have increased. When people will borrow less, then investment will be less, then consumption will be less, and then GDP will be less, and then inflation will be less. So this is a I will say, a contractionary type of policy. If I increase repo rate, you're getting my point. So I am discussing what are the tools of RBI, what are the tools of any country central bank. There are three tools which we are going to start with. One is policy rates. Within policy rates, we are coming with repo rate, reverse repo rate. Repo rate is the rate at which central bank lends the money to the commercial bank, and reverse repo is the rate at which commercial bank lends the money to the central bank. It is opposite. You're getting my point. The rate at which PNB, Punjab National Bank, will lend the money to central bank. Now, in this case, central bank is a borrower. That is that rate which this PNB will charge. That is named as reverse repo. And the rate at which central bank will charge, because at that time central bank is the lender, that is named as repo rate. So repo rate plays a very important role in affecting, or implementing the monetary policy. So please write down a point. The rate at which banks will borrow from the central bank, that is named as repo rate. If central bank increases the repo rate, then following cost will be increased. Very but natural, very intuitive. If repo rate increases, then borrowing cost will increase, then consumption will decrease. When borrowing costs increase, it is a demotivating factor to public. People will not borrow because interest costs have been increased, and when they will not borrow, they will not have money, and when they will don't have money, they don't have the liquidity. When they don't have the liquidity, they don't have the money for transaction purpose. And in that case, consumption will decrease. When consumption will decrease, ultimately investment will decrease, and ultimately GDP will decrease, and at last inflation will also decrease. So it is a tool in the hands of central bank that they can manage the inflation with the help of repo rates. Hope you have got the idea that how it is being related. The next point which I want to tell you is reserve requirement. The second tool which RBI has, the central bank of any country has, that is reserve requirement. We have discussed in the last lecture also. Now when I say reserve requirement, just see reserve ratios. These are the reserve ratios which a commercial bank has to keep, because we were discussing fragmented reserve banking system. As per fragmented reserve banking system, out of that $100, out of that 100 rupees which the banking company is getting as deposits, then this banking company should keep CRR as 4%, SLR, statutory liquidity requirement, at 19.5%. It means 19 plus 4, 23.5% is kept as the reserve, and the balance can be given as a loan. This is named as fragmented reserve banking system. So the point is, if central bank increases this rate, in that case every commercial bank has to keep a more reserve. It means they will have less amount of liquidity in their hands to give as a loan. It means they will increase the liquidity, it will decrease the liquidity, it will increase the interest cost, it will increase the borrowing cost. People will not be attracted, people will not be borrowing, interest cost will be increased. When people will not be attracted or will not be borrowing, ultimately what will happen, you see? What will happen? GDP will decrease and ultimately inflation will decrease. So I will say this type of policy is named as tight monetary policy. So we have three tools for implementing that monetary policy. The first tool is named as policy rates. The second is reserve ratio, and the third is open market operation. So before coming to that, just write down the reserve requirement. If reserve requirement CR plus SLR, as if now it is 23.5%, we have shown for India, goes up, it means they will have less money to give as loan, then funds available to lend money will go down. then interest rates will go up because fund supply has decreased, so interest will go up, then consumption will go down, investment will go down, GDP will go down, inflation will go down, and this is named as tight monetary policy. So my dear friends, with the help of this tool also, we can implement the objectives, or we can implement that monetary policy which we have framed. So I have discussed two. One is policy rates and second is reserve requirement. And the third tool which is very important, which is in the hands of central bank, that is named as open market operations. In case you are saying that business news channels CNX or CNBC profit, you might have heard about, open market operations. There are so many operations which are being transacted in economy to manage the liquidity. So I am on to tool number 3. How this open market operations will help central bank in managing the inflation and in managing the money supply, or in implementing the monetary policy. Now, when I say open market operations, it means Reserve Bank of India, the central bank of a country, sells their securities or buys their securities. Two things. Open market operations means either the central bank, when I say open market operations can be buying operation or operation can be selling operation. It means central bank, if requires the money, then can sell the securities to the commercial banks, and in that case commercial bank will buy those securities and the money will flow from commercial bank pocket to central bank pocket. Ultimately, the commercial bank will have low liquidity, low amount to give as loan, and hence interest cost will increase. And when interest cost will increase, it is a disincentive for the people. They will borrow less. When they will borrow less, there will be less investment. When there will be less investment, there will be less consumption. And when there is a less consumption, GDP will decrease and inflation will decrease. So by selling the securities, we can have a tight monetary policy, and we can, and if I see the opposite, by buying the security. So we are coming to that, but firstly write down this scenario. Scenario 1, selling bonds by central bank. Selling bonds by central bank. Selling bonds by central bank will reduce liquidity, because money will flow from the pocket of commercial banks to the pocket of RBI or central bank. Just see, I have given the scenarios also. Just see, this is the cash box of commercial bank and this is the cash box of central bank. Both are same. But when I say selling the securities, it means the money, RBI, central bank is selling the securities. In that case, money will flow from commercial bank pockets to reserve bank, central bank pocket. Just see, if on selling the securities, the balance has increased, the balance has decreased. When the balance will decrease, they will have less money to give as a loan. They will have less amount of money, liquidity, and ultimately interest cost will increase. So we are on to open market operations. Selling bonds by central bank will reduce liquidity, then borrowing cost will increase, then consumption will decrease, then investment will decrease, then GDP will decrease, and inflation will decrease. Case study for understanding the concept of open market operations. So I have prepared two cash boxes. One cash box is of commercial bank and second cash box is of central bank. Now, when central bank is selling the security, the cash will be going out from the pocket of commercial bank to the pocket of central bank, and ultimately they will have less money, we have just discussed. So please prepare this cash box also. I'm telling you, this will help you in understanding the concepts, because more the diagrams, more the flow charts, more the head highlighters, more will be the passing percentage, because more will be the understanding ratio. So like this, we can, on selling the securities by central bank to this, we have discussed that. Now banks will have less amount to lend, so interest rate will go up, GDP will go down, prices will go down. On contrast, if I see on buying the securities by central bank, if central bank will be buying it, in that case the central bank will be having less cash, and the all cash liquidity will go from the pocket of central bank to the pocket of commercial banks. Now commercial bank people, they have more amount of liquidity, more amount of funds to give as a loan, and ultimately when they can give as a loan, automatically interest will come down, borrowing cost will come down, people will be attracted, people will be motivated, they will be having more borrowing, more investment, more consumption, GDP will increase, and ultimately inflation will increase. So this is a process with the help of which we can, minimize or maximize the inflation rate. Commercial bank will have more money, interest rate will go down, GDP will increase, prices will increase, and inflation rate will increase. securities. So, my dear friends, we have discussed there are three tools in the hands of central bank to implement that monetary policy. One is the policy rate, second is the reserve requirement, and third is the open market operation. So let me show you what is the monetary policy of India. I want to just tell you what is the monetary RBI monetary policy 2018 is a policy formulated by central bank, RBI Reserve, and relates to monetary matters of this. So let's see. As per Wikipedia, the monetary policy or monetary policy 2018 as per Bank Bazaar. Let's see that. Key indicators. Cash reserve ratio will be this much, SLR will be this much, repo rate will be this much, reverse repo rate will be this much. We have just seen that. What is the meaning of that? Objectives of monetary policy. Promotion of saving and investment. This is the first objective. Controlling the import and export. This is the second objective. Managing business cycle. This is the third objective. Regulation of aggregate demand. This is the fourth objective. Generation of employment. Fifth objective. Helping with the development. Allocating more credit for the priority segments. Managing and developing in the banking sector. So these are the basic objectives of a monetary policy which can be only implemented with the help of those three tools. Let us see the monetary policy of Japan. Bank of Japan this has removed the time for achieving 2% target in a widely this. So let us see Bank of Japan monetary policy. What is the monetary policy of Bank of Japan? Let us see to that. Monetary policy reserve releases monetary policy meeting, monetary this. Okay. Outline or purchase of Japanese government securities, monetary policy. Just see. Okay, they have purchased some securities and we will be on this. Okay. So this is outline of outright purchase of Japanese government securities. It relates to open market securities. So with the help of open market securities, we can implement that monetary policy. The Bank of Japan is conducting conducting outright purchase of Japanese government securities. And this decided to conduct the purchase as follows. Outright purchase of Japanese government bonds to be purchased, frequency of purchase, amount to be purchased. It means with the help of open market operations, we can implement the monetary policy. Hope you have got the real context now what I want to tell you. Be happy, be jolly, be cheerful.